Hey, it's Elliot, and in today's video I wanted to warn you about trading signal scams and why you should not basically follow online signals. So I'm sure if you have an interest in trading, you must have seen trading signals, okay? It's literally the virus that we are seeing all over online. Why am I calling this a virus? Simply because we are seeing more and more people selling these online signals, and they do not benefit the people following or paying for these signals. So the first main issue to start with trading signals is the fact that they target beginner traders. Now the issue with that is a beginner trader following trading signals will be able to see the entry, the stop, the target, okay? However, trading is not only this, okay? The whole risk management part is probably even more important than the trading side of things. So someone that goes ahead and follows trading signals without having the proper knowledge, the proper risk management, the proper rules behind, will not be able to be successful following trading signals. Now, I know some signal provider will tell you if you have a $1,000 account, you just have to use 0.10 lots. If you have a $2,000 account, you just have to use a 0.20 lot. But this is bullshit. This is not how proper risk management is done. You can imagine any bank, any financial institution does not do an arbitrary rule of just saying 0.2 is 2,000, okay? Every single position size should be calculated depending on the trade, okay? Now, because trading signals target beginner traders, they are able to say whatever they want, and beginner traders won't know if it's true or if it's not. So the biggest false advertisement I'm seeing is the fact that signal providers tell you how many pips they made this month. And sadly, that has become the main knowledge beginner traders have. However, any professional trader will not look at performance in terms of pips, but percentage. The simple reason for this is, as I was explaining earlier, your position size will change depending on the trade. So the value of a pip will change depending on the trade. So if you're making 1,000 pips or 5,000 or minus 50, that won't impact the performance. I could literally go ahead and show you an account that was blown, so all the money has been lost. However, that account is over 2,500 pips in profit. So how does that happen? So why pips do not show performance? So let's say this is our first trade, okay? We go onto a euro dollar, we go long, so that means we buy, and our risk is 10 pips, okay? So we are risking 10 pips and our target is, let's say, 30 pips. So we are risking 10 pips in order to make 30 pips. Now, how we will do this is calculating our position size. So let's say we only want to risk $100 on the trade. Maybe this will equal to one lot, okay? So this is our position. We just took one lot and we are risking 10 pips and 30 pips potential profit. So worst case scenario is we will lose either minus 100 euros because this is what we've calculated, okay? Or best case scenario, we will make 300 euros, okay? Simply because we are basically targeting 3 times more what we are risking. Now, let's say on another trade taken on gold, okay, also known as this, and we go ahead on a longer time frame trade where we go ahead and risk 500 pips in order to make 1,500 pips. So same principle, we know that our maximum loss we want to get in is 100, let's say. So in that case, maybe our position sizing won't be one lot, but it will only be, let's say, a lot of 0.2, okay? So worst case scenario, we lose minus 100. That does not change, okay? Simply because we've adapted our position sizing. And best case scenario is we make 300 euro. Same, so it's 1,500 pips, but we only trading smaller lot because of our limited risk. So now let's say this trade went through. So we made plus 300 euros on euro dollar. And this trade did not go through. So we lost minus 100 euro on our gold trade. So what's the sum? Of course, in terms of profit, we are up 200 euros simply because we've made 300 and lost 100. Now, how about pips? We basically made 30 pips on the euro dollar trade, plus 30, and we lost minus 500 pips on the gold trade. So in terms of pips, we are negative, okay? We are negative in terms of pips. However, in terms of money, we did make money. And now this works on the opposite, obviously. So this is why pips do not represent performance at all. Now, the other big scam used by signal providers is just manipulating numbers, okay? In finance, it's very easy to do so. So I'm sure you've seen these signals that provide 90%, 95, 96, 97% success rate, hit rate. Now, as a total beginner, that sounds very good, okay? On 95% of the trades, you will make money. But to any professional trader, this 90%, 95% success rate is just laughable because you're only looking at one side of the coin, and just this 90% success rate on itself does not show any performance whatsoever. And the reason why success rate on itself does not mean anything is that you are not focusing on risk to reward. So for sure, you could have a success rate of 90% or even 95%. However, whenever a trade goes into profit, you just close it and take the profit. So your success rate is actually very high because you are making money on most of the trades. However, the few trades that do not go through, don't close them. Leave them in a loss, and this loss will just become huge and will go into that 10% of losses. However, guess what? The risk to reward on this will be huge risks, because whenever you lose a trade, you'll basically lose 80% of the account, and whenever you make a trade, it'll just be peanuts. So to give you an idea, some of the best asset managers I know have a success rate, a hit rate of less than 40%. However, their risk to reward is generally about 1 to 6 or 1 to 8. So whenever they lose 1, so let's say $100, but whenever they make money, they make 600, they make 800. So the goal in trading is not to be right, the goal is to make money, end of story. So now onto another scam used by signal providers, and it's offering free signals. For sure, a signal provider that offers free signals makes a lot of money, and he's not interested in your money because the signals are free. So it's definitely a good idea, correct? Well, absolutely not. What these people are generally doing is they get you onto free signals, and then they recommend you to their own forex broker, which is usually non-trustworthy brokers that generally you would not want to be part of. But anyway, by getting you to open an account with that broker, they make a flat fee commission, or 1 commission on every single trade you take. That means for sure the signals are free, but whenever they send a signal, they will make money on your own trade, whether it is a loss, whether it is a profit. It does not change anything. They are getting the commission. Now, where things get very dark is the fact that some brokers will actually allow the signal provider to increase the spread. Okay, let's say an increase of spread of 2 pips or 4 pips for each client. So the signal provider makes even more commission. So that means you, by following these free signals and joining this broker, you are getting the worst rates ever. But you actually don't even know it, because that rate, basically the money you're losing on these trades, is just going to the signal provider. So this is probably the worst thing ever. Now, how do I know this? Simply because I've been approached by hundreds of brokers offering me some commission-based partnership, okay, where they literally explained to me and showed me that I could increase the spread for every single client I brought so I could make even more money, right? And this is just not something I think is fair, and it's just horrible to see this in the trading niche. So yeah, I just wanted to let you know. But anyway, I'm sure there should be some good signal providers out there, some professional traders that come out of big hedge funds, that come out of Goldman Sachs, and that will provide signals. But the issue is we'll have the same problem. People do not have the risk management used by that professional trader. They don't have the trade management used by that professional trader. And as professional traders, believe me, we know and we understand that providing signals does not benefit 99% of the traders following them. So the truth is, professional traders don't generally offer trading signals, or if they do, they'll only do it for like 2 or 3 months and then realize that it basically does not work. And that's the reason why I do not provide trading signals, is that I just know they do not benefit the people following them. Even though for sure I could make a bit of money that way, but I'm just not interested to provide a service which I know the value is not there. Now, to sum it up for beginner traders, what I'd like to say is, if your goal is to win a Formula 1 Grand Prix, the first step you are going to take is not trying to follow the exact curve of Lewis Hamilton in the corners, okay? For sure not. It's going to be to pass your driving test first, to try and drive slowly first, okay? And it's exactly the same with trading signals. You're not going to try and follow what this professional, what this apparently successful trader is doing exactly. You are going to learn the basics first. So my biggest advice is education, education, and education in the FX trading and finance space. You can't win a Formula 1 Grand Prix if you do not know how to start a car. So I hope this video will save you a lot of money and a lot of experience. Feel free to leave down in the comments if there's any signals, trading signals, scams I've missed, and subscribe to my YouTube channel where I share videos about finance, trading, FX, etc. This is my Instagram if you need to contact me. And on this, it was Elliot. Have a good day.